What I'm looking at is AMZU, which is the direction double X leveraged ETF for Amazon. Now, I already own 100 shares of AMZU, and I am going to sell one contract today of cover calls. Let's see on the option tab. I am going to zoom it out a little bit. Let's go all the way about a year out. And I am going to set the strike price nine strikes. I am going to set my strike price today at 38.80. Okay, now in this case they're paying $6.40 each share. So again, I am going to sell open one contract. Expiration day is January 15, 2027. The strike price is 38.80. Call. This is the bid and ask spread. The last was 7.30. I am going to, let me put this here on market, and this is going to result to a proceed of nearly $640 deposited on my account right now. So I am going to go ahead and do that. I am going to place the order, and that's all that you gotta do. I just got the notification on my phone that the order was placed, and basically I'm done. I just made $640 deposited on my account. This AMZU is currently trading at, let me put this one up, $34.53 today. Is up nearly 1%. I do think that there is a lot of upside on Amazon, and as a result for the double X leverage ETF. If you go down 5 years, well, this ETF was actually born in September 2022, so we don't have a lot of data, but I hope that Amazon can deliver, and when they are going to release earnings, I think in January, I think that's gonna be a beat. Also for the holiday season and everything that they got going on, AWS, which is top provider for the cloud for many businesses. So I'm expecting that Amazon is, I wouldn't say underpriced, but I believe that in the next year or the following years, so definitely it might go up. So I owned 100 shares of this for about 30, at an average price of 36. So I'm looking at an investment over the next year of about $3,600, and I profited today $640. So I'm looking at about, I would say, 20% gain, and I already got paid. Okay, so now I think that's a pretty good deal. Now anything can happen to the price of AMZU, but I think it might go up to where I make this worthwhile for me. Also, if I was to put 3,600 in the stock market over the next year, really, I don't think I'm gonna get 20% return. I believe the stock market as a whole is overpriced and is way overpriced. So I want to be very careful on what I do. We are really in a uncharted overvaluation territory for the stock market. When the Schiller PE ratio is at all-time highs and the Buffett indicators all-time highs, I'm not gonna take a huge chance. So I think that was the right thing to do, and again, I believe in 2026 we might see a correction of the broad market, and I don't think the S&P 500 is going to deliver 20% over the next year, also because it's already delivered about 20% 3 consecutive years, including 2025. Now, when it comes to options, what happens here now, I am locked, I would say, up until January 15th, 2027, which is over a year from now. What happens is that if the AMZU price stays below the strike price, which was 38.80, in that case, nothing happens. Okay, you are going to keep your AMZU shares, and then you can sell another contract of cover calls. If the price hits or exceeds the strike price before the expiration date, the position would be then in the money, and you might feel that something might happen immediately. The reality is that it is usually quite quiet up until the final deadline. So again, even if the price hits the strike, but the option hasn't expired yet, in most cases nothing happens. Usually, if the stock price goes above your strike price, it is uncommon for the buyer to exercise the option early because of time value. Options have extrinsic value, which is the time value. If a buyer exercises early, they forfeit the remaining time value. Usually it is more profitable for them to sell the option contract to someone else rather than exercise it. And they wait. In most cases, you will simply see the value of your short call increase, showing a loss in your options tab. But you will still own those shares, and the option will remain open until the expiration date. While it is rare, the buyer does have the right to exercise at any time, and this is called the early assignment. This usually occurs if the option is deep in the money. That means that the stock is way above the strike or right before an ex-dividend date. If the stock is about to pay a dividend, the buyer might exercise early to own the shares and collect that payment. AMZU here, they pay, I believe, 2% dividend, and they're gonna pay, the ex-dividend day was actually the 10th of December, and they pay quarterly. So there are three common strategies. If the price hits the strike and you want to take action before expiration, you have three main choices. You can do nothing, let the contract run until expiration, and you are happy to sell the shares at a strike price and keep the premium. And usually this is what I do. I don't do anything. I let the contract run until expiration, and now in this case I'm gonna let that money there until January 15th, 2027, and I would be happy to collect the premium. My shares eventually are going to appreciate some price, and eventually I can write another cover call contract. The other thing that you can do is buy to close, which is you buy back the call option to cancel the contract. In that case, you keep your shares because you think that the stock will keep rising. But by doing that, again, if you close the contract, eventually this is going to cost you more than the premium that you received. So this is not something that I would do. The other thing that you might do is to roll the option. In that case, you buy back the current call and sell a new one with a later date or higher strike. And you do that if you want to avoid losing the shares now while collecting more premium for a future date. So basically, what happens again if the strike price is hit before the expiration? You have those three options. Let's do a little summary of outcomes at expiration. If the stock stays above the strike price through the expiration date, one, the shares are called away. You are automatically required to sell your 100 shares at a strike price. Two, cash settlement. You receive the cash from the sale, which is basically the strike price times 100. Three, keep the premium. You keep 100% of the initial premium you received when you first sold the call. So I hope this was useful, and it was a real life case of selling a contract of cover calls on AMZU. Happy trading, everyone.